Hey, welcome back to Insights by Stormfield Capital. Today we are talking about four terms you will run into constantly in real estate lending: fix and flip, bridge, hard money, and private money. But these get used a lot interchangeably, and it is not always clear what actually separates them. We are going to walk through four real borrowing situations and break down what each term means, how they overlap, and how to figure out which one applies to your deal. First thing to know, none of these terms are regulated. No government body defines what counts as a hard money loan versus a bridge loan. The fastest way to understand the difference is not to memorize definitions, it is to watch the same kinds of deals play out and see which label gets attached and why. Here are four situations a real estate investor actually runs into. Start with fix and flip. Picture this. An investor finds a rough single-family home for $280,000. Renovated homes in the same neighborhood are selling for $430,000. The plan is to put in around $70,000 of work and sell. A bank is not going to fund that. The house does not appraise well in its current state. The timeline is too short for a conventional product. And the investor needs renovation money released gradually as the work gets done, not all at once at closing. So they get a fix and flip loan. It is short-term, interest only, with a draw structure tied to construction milestones. Here is the key insight. Fix and flip is telling you what the money is for. It is a description of the purpose. Buy it, fix it, sell it. That is it. It does not describe how the loan is built or who is making it. Now that same investor shops the deal to a second lender. The quote comes back almost identical in structure, but the term sheet says bridge loan with a rehab component. Same rate, same leverage, the same draw schedule, but a different name. A bridge loan is about timing. It is filling a gap between where you are now and where you are going, whether that is a sale, a refinance, or stabilization. It does not specify what you are doing with the property. So a fix and flip loan is actually a subset of bridge lending. Both labels can describe the exact same product. The first lender thought about it in terms of what the borrower is doing. The second lender thought about it in terms of the timeline. Neither is wrong. Now let's look at a different scenario. An investor has a property under contract at a real discount, but the seller needs to close in 11 days, or they are moving on to the next buyer. This borrower actually has solid credit. They could eventually get a conventional loan, but they do not have it eventually. They have 11 days. Hard money is what they use. And this surprises a lot of people because hard money has a reputation as a last resort, something for borrowers who cannot qualify anywhere else. That reputation is outdated. Plenty of experienced, credit-worthy investors choose hard money on purpose because it moves fast and because the underwriting focuses on the asset, not a 60-day income verification process. Hard money is really describing how the loan is underwritten, asset-based, quick, outside the traditional banking system. Now, if that same investor was also planning to renovate the property, you could call that loan a fix and flip loan, a bridge loan, and a hard money loan all at once. One loan, three accurate labels. Last one. An investor is putting together financing for a value-add apartment building. The capital is coming from a debt fund, a pool of money that lends on real estate professionally. The investor always thought private money meant borrowing from a wealthy individual, someone who writes a check from their personal account. But the fund calls their product private money too, and they are right. Private money just means non-bank, non-agency lending. It covers individual investors, yes, but it also covers debt funds, family offices, mortgage REITs, and balance sheet lenders like Stormfield. Hard money sits inside private money. Hard money is one specific approach within a much bigger category. Every hard money loan is a private loan, but not every private loan is hard money. The apartment deal might not be hard money at all, but it is absolutely private money. Here's the simplest way to hold all of this. Each term answers a different question about the same loan. Fix and flip answers, what is it for? Bridge answers, what is the timing? Hard money answers, how is it underwritten? Private answers, who is the lender? A single renovation deal can be all four at the same time. Which label you hear just depends on which of those questions the lender leads with. Once you understand that, the confusion clears up pretty fast. So when you're looking at your next deal, stop trying to match a label. Start with the function. Are you buying something distressed, renovating it, and selling? You need short-term capital with a draw structure and underwriting based on what the property will be worth after the work. Are you bridging to a refinance or a sale? You need a lender focused on your exit, not just the current state of the asset. Once you are clear on what the money needs to do, then you compare the actual terms: rate, leverage, draw process, loan term, and prepayment. And then one more thing that matters more than most borrowers realize: how many deals like yours has this lender actually closed? A lender with real experience in your deal type is going to move faster, structure things more accurately, and handle the curveballs that every project throws. The name on the product is just marketing. The term sheet is what you are actually buying. If you want to learn more about how Stormfield structures fix and flip and bridge financing, visit stormfieldcapital.com. Link is in the description. See you in the next one.